On November 8, 1890, Edward Baring approached William Lidderdale, governor of the Bank of England, with a catastrophic admission. Baring Brothers and Company, one of London's oldest and most prestigious merchant banks, founded in 1762, was facing absolute insolvency. The institution held £21 million in immediate liabilities against just £3 million of equity capital. If Barings fell, credit markets would freeze, threatening to bring the entire British Empire's financial system to its knees.
This crisis originated halfway across the world, born from the great South American investment boom of the 1880s. Argentina was rapidly absorbing massive foreign investments to fund ambitious public works and railway expansions. By 1889, under President Miguel Juárez Celman, Argentina accounted for an astonishing 40 to 50% of all British global investment funds. Edward Baring pursued a highly aggressive strategy, underwriting Argentine sovereign debt at an unprecedented scale. The fatal move arrived in January 1889, when Barings underwrote the Buenos Aires Water Supply and Drainage Company bond. Historical sources actively debate the precise scale of Barings' lethal exposure. Some historians narrow the fatal blow specifically to this £2 million waterworks bond, while broader financial analyses point to a much larger accumulation of roughly £4.6 million in total unsold Argentine debt sitting on the bank's ledger. By late 1889, the geopolitical and economic music had stopped. British investors completely rejected any new Argentine debt. Because Barings underwrote these bonds on a firm commitment basis, the bank was contractually forced to absorb the unsellable paper itself. Meanwhile, Argentina was buckling under hyperinflation and deep civil unrest. On July 26, 1890, an armed uprising known as the Revolution of the Park erupted in the streets of Buenos Aires. President Celman was forced to resign, and Vice President Carlos Pellegrini assumed power on August 6th, desperately trying to prioritize state solvency. But the economic contraction was too severe to reverse. Edward Baring was left holding millions in worthless foreign paper. While subjective storytelling might speculate on Baring's psychological anguish as his family's empire crumbled, the historical record shows only his ultimate, desperate decision, turning to the Bank of England for survival.
The British financial establishment was abruptly facing an existential threat. With £21 million in immediate liabilities, Barings simply could not pay its creditors. Governor Lidderdale understood that allowing a major merchant bank to abruptly fail would trigger a catastrophic panic across London. Other institutions would instantly hoard cash, lending would halt, and the complex architecture of Victorian global trade could collapse entirely. However, organizing an international rescue required immense immediate liquidity, which the Bank of England could not provide without dangerously draining its own gold reserves. Time was rapidly running out. Lidderdale and the British government had to architect a systemic intervention, one that had never been attempted on such a massive scale, all before the general public caught wind of the impending doom.
Between November 10th and 14th, 1890, Lidderdale moved decisively to orchestrate a financial miracle. With crucial help from merchant banker Nathan Rothschild, the Bank of England secretly arranged £4.5 million in international gold swaps, pulling emergency liquidity from France and Russia. Simultaneously, Chancellor of the Exchequer George Goschen authorized the suspension of the Bank of England's strict gold reserve requirements. This extraordinary coordination culminated on November 15th. Lidderdale established an unprecedented £17 million guarantee fund to officially backstop Barings' liabilities. The Bank of England contributed £1 million, while a consortium of London banks provided £7.5 million. They had successfully built a massive firewall around the failing institution just 24 hours before making the crisis public on November 16th.
The immediate panic in London was averted, but the international fallout was profound. By 1891, Argentina officially defaulted on £48 million in debt. To understand the sheer scale of this collapse, this staggering sum constituted roughly 60% of all sovereign debt defaulted on globally during the entire decade of the 1890s. Inside Argentina, the Banco Nacional collapsed by April 1891, and the nation's gross domestic product violently contracted by 11%. Nathan Rothschild subsequently chaired a committee to manage the restructuring of Argentine obligations, culminating in the 1893 Romero settlement. Modern commentators frequently mislabel this intervention as a traditional bank bailout. In reality, the rescue exclusively backstopped creditors and market liquidity. The original Baring Brothers partnership was mercilessly liquidated, and the partners lost their personal wealth.
The sudden halt in British capital flows following the Baring crisis sent devastating shockwaves across the globe. The abrupt end to foreign lending popped a massive economic bubble in Brazil and severed vital funding lines to Australia, serving as a primary catalyst for the Australian banking crisis of 1893. The events of 1890 stand as a stark historical warning about the cascading vulnerability of interconnected global markets. The Bank of England's intervention created a permanent blueprint for modern central banking. It succeeded not by shielding careless executives from the consequences of their risks, but by deploying overwhelming, coordinated liquidity to prevent the collapse of one institution from dragging down the rest of the world economy.